Welcome back. Welcome back to the Machine of All Trades, Master of None. I am the ghost in the machine and the financial markets where I operate. Well, guys, be patient with me. I'm going to try and deliver videos consistently. You know, I'm going to try and deliver videos consistently. I'm looking for my light. Because I want to light some candlestick. Because I want to learn something about some candlesticks. Because, yeah, we're going to learn something about some candlesticks. About some Japanese candlesticks, some chompi. Yeah, we'll learn about dealing range. Dealing ranges. I didn't know what to say. Dealing range or dealing ranges. I just opted for dealing range. But anyway, a dealing range is a tool that shows the external and external price range liquidity between two points in a chart, helping traders determine buyers' direction and points of entry for market execution. Guys, I like reading slowly because that's when I can speak English fluently. That's a good feeling. But the thing is, I hate reading at the same time. I mean, I only read one novel in my life, and I read about maybe 40%, 30% of it, and 30% of it was a short story by itself, or a novel. It had to be a short novel by itself, but they just got like two stories in one novel, like that. Like the story was like the author was crazy at that time. Like he was too happy. I don't know. Maybe he was on mushrooms or the same sativa that I'm on. Like I don't know. Like I only read that and I was done. I hate reading. I never went to lectures when I was at university. I don't. I whatever. A dealing range is a tool. A dealing range is a tool that shows external and internal price range liquidity between 2 points on a chart, helping traders determine buyers or direction and points of entry for execution. Yeah, like you heard, we're going to use a dealing range to find our internal and external liquidity. I've told you about liquidity. I told you about liquidity in the past videos, in the past video. So yeah, we're going to look at we're going to use a dealing range to find those things. I'm going to teach you about how to use a dealing range, whatever that tool. Yeah, and we're going to use that dealing range to help ourselves to find our point of entries or we want to enter. Okay, what's a dealing range? What is a range in the chart? So we're not talking about the dealing range exactly, but we're talking about a range combined whatever. Range is a term used to describe when price is trending between a defined high and low, moving within these two boundaries, targeting to test or break some price levels of inefficiency and liquidity. I'm going to teach you guys about inefficiencies. Inefficiencies are some forms of liquidity. It's a form of liquidity in a way, whatever. Inefficiencies are found within a dealing range. Again, I told you that in a dealing range, you're going to find internal and external liquidity. And I'll leave the structure. A liquidity at this top and at this bottom. That's where our liquidities might be. And also, like I told you, they're at old highs and old lows, highs, lows. There is some of liquidity. It might be little, but it's something. One puller is better than, I don't know what I was trying to say. Whatever. Yeah, that's where liquidity is. And again, the inefficiencies are found within a dealing range. There are inefficiencies that I'm going to teach you about. This from that high to here is an efficiency. Someone who knows inefficiency is going crazy right now, like, hey, the machine. That's not an efficiency. Are you crazy? Wait, chill. That's a inefficiency. I was trying to describe it of its form. Because I'm not great with terminology. I just know that this is an efficiency, and ICT told that. what is the price, whatever, in efficiency. When price goes up, it has delivered on the buy side and it is inefficient on sell side. And its sell side was covered a bit here, and and buy side was left from this low to here, and it was covered where when it went down. It filled that fully this imbalance. Yeah, anyway, let's not argue. Areas of liquidity are found at external high and low of the dealing range, and external highs and low within. I always extending the future. Like, I shouldn't have notes. I just need to explain. I get. In a dealing range, we have levels of premium and discount. Like I told you guys, we want to buy at discount levels and we want to sell at premium levels. Remember that, right? So yeah. This triangle. Wait. This square, this rectangle. I don't think it's a square. I think it's a rectangle. I was trying to make a rectangle, but it formed into a square. That. Well, that shows how artistic I am. Even in bed, I sleep well like it because I don't have stress. I sleep well, no stress. Okay, this is a dealing range. Why is it a dealing range? A dealing range is formed when price breaks an old high of significance, an old high that it has established a low, a bearish trend, and that bearish trend, that when it was formed, we broke that level. So that when we broke that level and still continued to the upside, the moment when it turned down and broke a significant low, which was significant as it was going from this low to that high, once it breaks it, we label that top that it made as our dealing range high, and this will be our dealing range low. You understand? And the middle of that, it will be our equilibrium level. And our equilibrium level is going to help us discover our premium and discount levels. Premium is higher prices, so our premium level will be above here. Our discount level will be below there. So what do we want to do? When price goes above, when it's going there, we want to buy where? Below discount levels. And we want to buy here and we want to sell above. So once it breaks, I told you what the level there's as a high of the dealing range, because that's where we expect the retracement back to our discount levels so that smart man can buy and we can help them on the buying. Like, we are on the window and looking what they are doing. Like, like when you are young there, not saying that that happened to me, but when you are young there, you look at the window there, you see people doing what they do in the bed, and you go and months later or days later or hours later, if you're a gangster, if you're a pimp, if you're if you're a pimp, whatever, you will do that. You will do what you see and what you have seen, what they were doing in the bed. That's what happens, understand? So now we are there looking what smart man is doing, and in the bank with the banks, they're sleeping them rough. They're sleeping them rough, and when we see them they're sleeping them rough, we go to the retail traders and we sleep them rough too, and then we benefit with the brokers, and we buy at those levels. We buy, and people always ask the machine, you say we buy at discount levels, so once it gets into premium levels, can we buy or do we sell? My nigga, we buy. We like buy them even more. Even it's much riskier because above here there's clouds of liquidity. There are people who think that other smart man traders who think that the market the market will sell here, will sell here, will sell there at those highs. There are people who claim that they know the market. Now, once they are developing those orders, now we are waiting for them to develop, and we consume. We use them. You know, badly, like that. So these are our premium levels, these are our discount levels. And people, like, you don't need to wait for you to buy at discount. You can start selling at premium levels for that retracement to go to discount levels. So they say the best sales that they will happen maybe 50% of that premium level, or maybe while it's still going there until a significant discount level that we have discovered that we think smart money will buy from. That's where we take our profit and establish our new loans. But that's more risky, so it's better when you're a beginner taking your prices, taking your entry at discount levels. And when it's in a bearish trend, you take it on what? On your premium levels, not at your discount. You take them when it's like falling, and when it's like falling and it's like this and it breaks, you want to buy, you want to sell here and keep selling there to target this whatever significant low that you have made of liquidity. Now we are buying here and still buying. Even want to buy more somewhere here, because he is going to make a what, a buy, a market buy sell model, which we like. But anyway, yeah, so yeah, or maybe we'll just continue. We don't care. So yeah, we keep buying, targeting here. So you can have a daily chart or a weekly chart. It's a maha, and you buy from going somewhere here, and you buy from here. Like my nigga, you're going to be benefiting weeks of buying and internal selling, internal buying, but overall buying until it goes there. Well, yeah. In a dealing range, we have levels of premium and discount, whatever. We use the Fibonacci tool to label the dealing range high, low, and equilibrium level and other important levels. So you take your Fibonacci, which you would have on the settings labeled your 0 and your 1 and your 0.5, which will be your 50% of that dealing range, which 50% of that Fibonacci. And you take your you don't you take you start your Fibonacci from here and end it through there, or maybe start it from here or put it in at that level. Correct. It has to be at that level. And the 50%, that will be your equilibrium, and below that will be your discount, and above that will be your premium. Hit your discount, you keep on buying, still up at the other side. Important rules. Maybe there are more rules, I don't know. I just wrote these things because I just wanted to finish with this lecture. One, we want price after it has displaced higher when bullish to retrace back to discount levels for a buy entry, like what I explained. It is placed from this low to that higher, when it displays higher, breaking that low, that old high, showing showing that influence, or yeah, we want to go up. So we are going to mitigate our orders that we used to sell to trigger our more orders for buying. Mitigate those things, take at them at a loss, at a small loss, or at no loss, or at a profit, and then head above. I'll explain more about mitigation in the future. It's very important about whatever. Yeah, I told you about those things, which is below the 50% of the dealing range. Yeah, that's where our discount level is. Below the equilibrium is where we want to find point of interest, or for buy entries, and then carry on entering into newly formed point of interest, which are in line with buyers to target the dealing range, external and internal liquidity, or areas of inefficiency within or outside higher than the dealing range. 3, if price breaks below the dealing range low, it may most probably be market structure shift to the downside to implement bearishness, or just a stop run or stop read, or if you read, hence wait for market to show us clearly what's happening. Thanks for watching. Remember, money management, risk management, a good psychology, a good strategy, or analyzing concept, Falcon, whatever, trade plan, trade management is the only way as the only way you're going to profitably be consistent, win consistently profitable or constantly profitable or profitably consistent and win in this industry. Treat this as a business. This is the machine of all trades, master of none. I'm the ghost in the machine. The financial markets is where I operate, my nigga. I'm the enigma. Yeah. Ah, track winner. Sharp.